Hello, welcome to Capital Sensei. Today we're going to dive deep into a legendary book, one that's often called the Bible of value investing. It's so sought after that used copies can sell for thousands of dollars. We're talking about Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor by Seth Klarman. We will unpack the three core pillars of his philosophy: the crucial difference between investing and speculating, the practical process of hunting for bargains in the market's forgotten corners, and, most importantly, the psychological discipline required to protect your capital and thrive long-term. As we go through these powerful ideas, you'll likely have questions or see connections to your own experiences. Whenever we can, we try to answer questions in the comments, so please feel free to share your thoughts, your doubts, or any stories you have. It makes this a much richer learning experience for everyone and helps build a community of sharp, thoughtful investors. So, who is this Seth Klarman? And why is his book from 1991 still considered such a treasure? Klarman is the head of the Baupost Group, a private investment partnership he founded in 1982. He's often called the Oracle of Boston, a nod to Warren Buffett's Oracle of Omaha title. And for good reason. His track record of delivering consistent, high returns with relatively low risk is nothing short of extraordinary. The book itself has become a legend because it was never reprinted. It's a rare artifact that contains the blueprints of his entire investment philosophy, laid out with incredible clarity. At the very heart of the book is the concept that gives it its title, the margin of safety. This idea wasn't invented by Klarman. He inherited it from his own intellectual hero, Benjamin Graham, who was Warren Buffett's mentor. So what is it? Imagine you're an engineer tasked with building a bridge. You calculate that the bridge needs to be able to hold a maximum load of, say, 10,000 tons. Do you build it to withstand exactly 10,000 tons? Of course not. That would be incredibly reckless. You build it to withstand 20,000, maybe even 30,000 tons. That massive cushion, that extra capacity, beyond what you expect to need, is your margin of safety. It protects you from miscalculations, unforeseen stresses, bad weather, or anything else that could go wrong. In investing, the principle is identical. The margin of safety is the discount between the price you pay for an asset and its underlying or intrinsic value. You do your homework, you analyze a business, and you calculate that it's worth, let's say, $100 per share. You don't buy it at $98. That's cutting it too fine. A value investor waits patiently until they can buy that $100 business for $60 or $50 or even less. That $40 or $50 gap is your margin of safety. It's your protection against being wrong, against a changing world, against bad luck. It's the ultimate defense. This brings us to the first major pillar of Klarman's thinking. You must understand the profound difference between investing and speculating. This isn't just semantics. It's a fundamental mindset shift that determines everything. An investor, in Klarman's view, treats a stock purchase as buying a fractional ownership in a real business. Their return is tied to the future earnings and cash flows of that business. They are focused on the intrinsic value of the asset itself. A speculator, on the other hand, isn't concerned with value. They buy an asset simply because they believe its price will go up. They're betting on market psychology, on trends, on the hope that someone else, a greater fool, will come along and pay more for it later. They're not analyzing the business. They're trying to predict the whims of the crowd. Klarman is very clear. Speculation is a loser's game over the long run. It's like playing musical chairs with your money. Eventually, the music stops, and someone is left without a seat. Think about it like this. Buying a rental property is an act of investment. You analyze the neighborhood, the potential rental income, the upkeep costs, the property taxes. You're calculating your return based on the cash the asset itself produces. Now, contrast that with buying a hot new cryptocurrency that has no underlying assets or cash flow, purely because its price has been rocketing up and you've got a bad case of FOMO, or fear of missing out. That's pure speculation. You're not buying a business, you're buying a price chart. To navigate this, Klarman leans heavily on another of Ben Grant's brilliant allegories, Mr. Market. Imagine you're in business with a partner named Mr. Market. Every single day, he comes to your office and offers to either buy your share of the business or sell you his share. The catch is, your partner is manic depressive. Some days, he's euphoric. He sees a glorious future, and he offers to buy your share for an absurdly high price. On other days, he's deeply pessimistic. He's convinced the business is doomed, and he offers to sell you his share for pennies on the dollar. A speculator gets swept up in Mr. Market's moods. When he's euphoric, the speculator gets excited and buys at high prices. When he's depressed, the speculator panics and sells at low prices. The true investor, however, does the opposite. They ignore Mr. Market's mood swings. They use their own independent analysis of the business's value as their anchor. They see his manic highs as an opportunity to perhaps sell, and they view his depressive lows as a golden opportunity to buy a great business at a foolishly low price. You are there to serve your own interests, not to be a servant to his emotional volatility. This leads to the second major pillar, the actual process of finding these bargains. If value investing is so great, why isn't everyone doing it? And if these opportunities exist, where are they? Klarman's answer is that you have to look where others aren't willing to look. Value is rarely found in the popular, well-followed story stocks that dominate the financial news. Instead, it's often hiding in the messy, the boring, the complicated, and the discarded corners of the market. Klarman is a master of investing in what he calls catalysts. A catalyst is a specific, foreseeable event that will force the market to reevaluate an asset and recognize its true, hidden value. You might find a company that's deeply undervalued, but without a catalyst, it could stay undervalued for years. The catalyst is the key that unlocks the value. What does this look like in practice? It could be a corporate spin-off, a restructuring, a liquidation, or even an acquisition. Let's take spin-offs, a classic value investing hunting ground. Imagine a huge, diversified conglomerate. Let's call it Megacorp. Megacorp is mostly known for its industrial manufacturing business, and that's what all the Wall Street analysts focus on. But buried inside Megacorp is a small but profitable chain of specialty pet food stores. It's a good little business, but it's so small compared to the manufacturing arm that nobody pays it any attention. It's a rounding error in Megacorp's financial reports. Then, management decides to spin off the pet food business into a new, independent, publicly traded company. Suddenly, this orphan business has to stand on its own. Initially, many of the large institutions that owned Megacorp will immediately sell their shares of the new Pet Food Co. Why? Because it's too small for their giant portfolios, or it doesn't fit their investment mandate, or they simply don't know anything about it. This indiscriminate selling can push the price of Pet Food Co. down to absurdly cheap levels, creating a perfect opportunity for a diligent investor who has done the homework to pick it up at a discount. Another area Klarman is famous for is distressed debt. Now, this sounds complicated, but the logic is simple. Let's say a company has borrowed a lot of money by issuing bonds, which are essentially just loans. Now the company is in trouble and might not be able to pay the money back. Fear grips the market, and investors who own these bonds rush to sell them. A bond that was supposed to pay back $1,000 might now be trading for just $400. Most people run away from this situation. A value investor, however, runs toward it to do the analysis. They might dig into the company's finances and realize that even if the company goes bankrupt and has to sell everything, its factories, its inventory, its patents, there would still be enough money to pay the bondholders back, $600 for every $1,000 they are owed. If you can buy that bond for $400, knowing you will very likely get at least $600 back, you have an incredible margin of safety. You've essentially limited your downside while giving yourself significant upside. You're profiting from panic. Klarman also emphasizes that value can be found in simple neglect. Sometimes a company is just plain boring. It doesn't have a sexy story. It's in an out-of-favor industry, like, say, a manufacturer of paper files and folders in a digital world. The company might be consistently profitable, have no debt, and pay a nice dividend. But because it's not a high-growth tech company, nobody cares. These boring companies can often trade for far less than their tangible assets are worth, offering a quiet, low-risk opportunity for the patient investor. This whole process requires a certain kind of temperament, which brings us to the third and perhaps most important pillar of Klarman's philosophy: risk management and investor psychology. This is where most people fail. They might understand the math, but they don't have the emotional discipline to execute the strategy. Klarman's first point here is revolutionary for many people. Risk is not volatility. Modern financial theory, the kind taught in most business schools, defines risk as beta, which is a measure of how much a stock's price bounces around compared to the overall market. To Klarman, this is nonsense. A stock price bouncing around doesn't mean you're losing money. The true definition of risk for a value investor is the probability of a permanent loss of capital. That's it. It's the only risk that matters. Think about it. A stock you bought for $50 that you know is worth $100 might be very volatile. It might swing down to $40 and up to $60 in a matter of weeks. According to academic theory, it's risky. But is it really? Your risk of permanently losing money is low because you bought it so cheap. Conversely, a supposedly safe, stable, blue-chip stock that everyone loves could be incredibly risky if you pay $200 for it when it's only worth $100. If the story changes and the price falls to its real value, you've permanently lost half your money. Volatility is a distraction. Price is reality. To manage this real risk, you need to be an independent thinker, and that means being aware of what Klarman calls the institutional imperative. This is the tendency for large organizations, like mutual funds and pension funds, to act in ways that protect the careers of the managers rather than maximize the returns for the clients. Fund managers are terrified of underperforming their peers or the market index, even in the short term. This leads to herd-like behavior. If a hot tech stock is soaring, a fund manager might feel compelled to buy it, even if they secretly think it's overvalued. Why? Because if they don't own it and it keeps going up, they'll look foolish and might lose their job. But if they buy it and it crashes, well, everyone else owned it too, so it's an excusable mistake. This safety and numbers thinking creates massive distortions in the market, pushing popular stocks to absurd valuations and leaving unpopular ones in the dustbin. This is precisely where the individual investor has a massive advantage. You don't have to answer to a committee. You don't have to worry about short-term performance. You can be patient. Patience is a superpower in investing. Klarman describes value investing as a combination of high intellectual curiosity and low emotional response. You need the drive to dig through financial statements and understand complex situations, but you also need the emotional fortitude to sit on your hands and do nothing for long periods when no bargains are available. It can be boring. Your friends might be bragging about the money they're making on the latest hot stock, while you're just sitting there, waiting. Ben Graham used a great baseball analogy for this. An investor is like a batter who gets to stand at the plate, and the market throws thousands of pitches. In baseball, you have to swing after 3 strikes. But in investing, there are no called strikes. You can stand there all day and watch pitches go by. Overvalued tech stocks, speculative biotech, complicated derivatives. You don't have to swing. You can wait and wait and wait for that one perfect pitch, that fat, slow softball right down the middle of the plate. That's your 50-cent dollar. Only then do you swing, and you swing hard. Finally, all of this must be built on a foundation of intellectual humility. You must accept that the future is fundamentally unknowable. You will make mistakes. Your analysis will sometimes be wrong. The world will change in ways you can't predict. This is precisely why the margin of safety is so critical. It's not a tool for generating higher returns. It's a tool for survival. It's the cushion that protects you when you're wrong. An investor who demands a large margin of safety is implicitly admitting, I don't know what's going to happen, so I need to build in a huge buffer for error. An investor who pays full price for an asset is implicitly saying, I am certain about the future. And as we know, certainty is the most dangerous thing an investor can have. Let's try to tie this all together with a hypothetical example. Let's imagine a company called Rust Belt Machinery. It's a 100-year-old company that makes parts for heavy industrial equipment. It's in a cyclical, unglamorous industry. The stock has been flat for 5 years, and it trades for $20 a share. All the smart money is focused on AI and cloud computing. Nobody even knows Rust Belt Machinery exists. You decide to investigate. You're acting like an investor, not a speculator. You pull up their financial reports. First thing you notice, the company has 0 debt. That's a huge plus. It means they can survive a recession. Second, you see they have $10 per share in cash, just sitting on their balance sheet. So when you buy the stock for $20, you're immediately getting $10 in cash. You're really only paying $10 for the actual operating business. Then you dig deeper. You find that the company owns its main factory and the huge plot of land it sits on, which is now in a rapidly gentrifying industrial district. You hire a local real estate appraiser, and they tell you that the land alone, if sold, is worth about $15 per share. So now, you're paying $20 for a stock that has $10 in cash and $15 in land. That's $25 of hard assets, and you haven't even considered the value of the machinery business itself, which, while boring, actually generates a small but steady profit each year. The intrinsic value here is clearly far higher than the $20 stock price. It might be $30 or even $40 per share. By buying at $20, you have a massive margin of safety. What could go wrong? Even if the machinery business goes to 0, you have $25 in tangible assets to cushion your fall. Your risk of permanent capital loss is incredibly low. And what's the potential catalyst? Management could announce a plan to sell the excess real estate and distribute the cash to shareholders as a special dividend. Or a larger company might realize how cheap it is and try to acquire it. You don't know for sure, but you've stacked the odds heavily in your favor. You bought a $100 business for $50, and now you can afford to be patient. So, when you boil it all down, Seth Klarman's margin of safety is more than just an investment manual. It's a comprehensive philosophy for rational decision-making in an uncertain world. It teaches you to separate reality from market sentiment, to focus on what you can control, the price you pay, and to protect yourself from what you can't. The key lessons are timeless. First, always know if you're investing or speculating. Are you buying a business or a lottery ticket? Second, demand a discount. The margin of safety is your best friend and your only true protection. Third, think for yourself. The crowd is almost always wrong at the extremes, and that's where your greatest opportunities lie. And finally, remember that risk isn't a number on a screen. It's the real-world chance of losing your hard-earned money for good. By focusing on avoiding losses, Klarman teaches us that gains will eventually take care of themselves. It's a defensive strategy, but over the long run, a powerful defense is the best offense you can have.